Welcome, friend, to Educare IS. This is a new initiative in which we are providing the information and education online, that too without any cost on YouTube channel free. That YouTube channel is Educare IS. Today's topic is blockchain technology and its effect. As we have seen that blockchain technology is too much in the news. So you have known about Bitcoin, you know about Ripple, you know about a lot of cryptocurrencies that is actually working on the blockchain technology. So basically, first question is that what is a blockchain technology? A blockchain technology is a technology which is based on the decentralized and distributed digital ledger. It is used for the online transaction, but it is not only for the online transaction, but basically it is a distributed and decentralized information system. It is used to record transaction across many computers so that the record cannot be altered retroactively without the alteration of all subsequent blocks and the collision of the network. So basically, if we go to see the what happens in the blockchain technology, then we should know that how it is different from the traditional banking and banking technology, traditional banking ledgering technology. So in the traditional technology, what happens? There is a central bank, so central bank monitors all other bank, and uh, from there we all are connected as a user. So it is a centralized, and it is a not distributed. The information is not distributed equally to all channels, all nodes. Here the distribution is kept with the central bank, and little information is kept with the banks, and we have a very little information about all the ledgers. But in the blockchain technology, what happens? This does not have any centralized bank or any centralized ledgering system. In this ledger that is a public register, you can say, in which all the information regarding the transaction is kept. So in this, the ledger is available to every user, and these users have means every piece of information is noted on this ledger, and in this system, if any alteration in the information is there, that is easily available to the everyone connected to the nodes. So basically it is a networking in which there is no centralized authority, in which there is no mediators, intermediaries. So all the information is controlled by us. So what will happen with this technology, blockchain technology? What it will do? It will do, if there is any alteration in the traditional banking central banking system, traditional system. Then what happens? If you need to do any alteration, you can do it from the central bank only. Means like, if you want to conceal, if central bank want to conceal any information, it can conceal it or it can disclose it. It depends on them. It's within their authority. But in the blockchain technology, distributed ledger system, what happens if any alteration or any information is coming, then and you want to hack it, you want to conceal the information, then you need to alter multiple nodes. Means like, if you are changing one nodes, it will not be changed, like it is distributed among various nodes. So if you are changing the information of this ledger, then this will not be changed. You need to simultaneously change the information of this, and this. Means a lot of nodes are there whom you need to tamper. So next question come, what would be how why it is called disrupting technology, and what would be the benefits of it? It is called disrupting technology because it will change the relations, it will change the centralized information system to more decentralized, to more distributed information system, and it can be used in the multiple uh, industries, multiple areas. It can be used in education, it can be used in the banking, it can be used in the insurance, it can be used in the industry output as multiple. It can be used when you're in environmental monitoring and everything. So it can be used in your medical system, like you give your medical information to particular hospital, to particular doctor, but if they will be using blockchain technology, it will be kept with the multiple doctors connected with the node simultaneously with you also. So if you are going to one doctor and you're going to again another doctor, you need not to present it again and again. So information is kept to everyone. So next thing is that what can be the benefits of this disrupting technology? First thing, it is a more secure because you simultaneously need to alter a multiple number of nodes. Second thing, it is a faster, like traditional banking system. If you go, then really you can one transaction takes around 2-3 minutes or something like that. But with the blockchain technology, it will be taking very less time. Like in Bitcoin blockchain technology, the information 1 second, in 1 second there is a 8 transaction, and in Ripple there is a multiple thousands of transaction can be rendered in 1 second. Third thing is that it is very cheaper, like there is a if you remove the intermediaries, then their commissions will also go down. Fourth thing, it is equitable. Means like in previous system, what we have seen that information and everything is kept with the one centralized authority. But in this system, the information is distributed to the everyone. Fifth thing is that problem of double spending, which is a banking term, will be removed. The double spending, what is double spending? Double spending is like if you are a bank user and you have account and you give a command to bank to send money to someone, but it will take some time. And in between, if you have given another command to bank to send same money to any other person, then bank cannot uh, actively utilize it. Means like you have 6,000 money and you give it to the first person, you give it to 4,000, and second person you give to the 3,000. Then bank cannot monitor it. So there is a double problem of double spending in accounting terms. Sixth thing is it is more transparent because multiple registers are maintained, everyone knows what is going on, so it is a quite transparent. And seventh thing is that it is more globally connected. Obviously, the information systems, information networking systems worldwide will be connected more globally with this blockchain technology. So what can be done with the blockchain technology? The blockchain technology can be used for a variety of applications such as tracking ownership for provenance of documents, digital assets, fiscal assets, or voting rights. Even for the voting rights, it can be used. Blockchain technology was popularized by Bitcoin digital currency system, but essentially blockchain is just a special kind of database. So we need to be very focused on this, that blockchain technology is not only the cryptocurrency, is not only the Bitcoin, it is a more than Bitcoin, and it is a special kind of database actually. So next thing comes that how it will disrupt traditional industrial setting. Traditional industrial setting is based on the owner-employer relationship, where surplus profit is being distributed unequally. More predominant part is going to the owner and rich. But with the distributed token economy, blockchain technology is called token economy also. Distributed token economy based on the blockchain ledger information will be distributed to various global networks, which in return will save the new industrial system where relation will be converted from employer to equal partners. So now we can see a video for more illustration that is from complex wave. So I think enjoy the
With the
video.
ongoing revolution in information technology, our economic systems of organization are being transformed and disrupted by the rise of information networks. It started with the advent of the personal computer, World Wide Web, and with the rise of online platforms, the disruptive power of information networks to reshape economic organization became ever more apparent. Today, this process of economic transformation continues with a new set of technologies as we are currently in the process of remaking the technology stack of the Internet, building what is called Web 3.0, a primary component of which is the blockchain. The defining feature of this next stage of economic development is that it decentralizes our economy and shifts operations to global information-based networks like never before. This distributed Internet technology stack that is currently being built enables a network of computers to maintain a collective database of value ownership and exchanges via Internet protocols. This bookkeeping is neither closed nor the control of one party. Rather, it is public and available in one digital ledger which is distributed across the network. The most mature example of this is what we call the blockchain. In the blockchain, all transactions are logged, including information on the date, time, participants, and amount of every single transaction. On the basis of sophisticated mathematical principles, the transactions are verified by the so-called miners who run the computing infrastructure required to maintain the ledgers. The technology of Web 3.0 enables a new form of decentralized economy as it removes the dependency on a centralized authority for managing the network, instead replacing it with a distributed consensus model managed by many. This shared, securely encrypted database enables trustless, peer-to-peer interactions via new Internet protocols. People can begin to set up their own networks for coordination and direct exchanges of value peer-to-peer, and it enables the rules of these transactions to be automated in new ways. At the heart of this system is the distributed ledger, which records the exchanges of value. These distributed ledgers can account for and validate the exchange of any form of value. It may be a currency, it may be property, it may be a kilowatt hour of energy, the usage of a parking spot, the number of followers a person has on social media. These distributed ledgers provide the infrastructure for building token economies. A token is simply a quantified unit of value. Tokens are both generic and fungible. It is generic in that it can be used to define any form of value, and it is fungible, meaning it is exchangeable between different specific forms of value. Traditional monetary currencies are not fully fungible, as there are many circumstances when one cannot exchange a monetary currency for other forms of value. For example, likes on social media may have a certain value, but typically cannot be directly exchanged for monetary currencies. A token differs from our traditional monetary currency in that it is more generic. Our existing currencies define a particular type of monetary value, what we call utility, which is based upon the economic logic of the industrial economy, while tokens, because they are more generic, can define a broader set of values, social capital, natural capital, or cultural capital. For example, natural capital is the integrity of an ecosystem that enables it to function and provide ecosystems services to people. In our traditional economic model, we only quantify and account for the services that the ecosystem delivers, such as food, water, materials, etc. However, we do not account for the integrity of the ecosystem that enables it to function. The generic nature of the token means it can be used to account for values such as this natural capital. The capacity to differentiate between different forms of value is made possible by the programmability of token units. Because tokens are digital, they are also programmable, which enables one to specify certain rules for that token and have those rules executed when it is exchanged, thus enabling certain constraints or possibilities in its usage. One can specify that a certain token is only spendable under certain terms, or specify how it can be converted. For example, one could program the token so that it cannot be exchanged for diamonds that are mined in a particular location of the world known for its use of slave labor. In this way, the token is not just a unit of utility, but also expresses social values. Likewise, One could create a healthcare allowance in dollars or euros that could be programmed on the blockchain so that it can only be used to pay for healthcare at certified parties. Automating these measures leads to a considerable decrease in bureaucracy. This programmable token system works to shift our economies from a single value model to a multi-value model. They create many different types of value and economies, but still retain the possibility for exchange between them. The distributed web is the convergence of the economic market system with information technology that enables us to convert traditional organizations into distributed markets based on tokens. Tokens define whatever is of value within that organization, and the market system is used as a distributed coordination mechanism for managing and growing that resource. By creating an expanded definition of value and converting closed organizations into open markets, this means that we can vastly expand the scope and capacities of the economy. The provisioning of services within the economy no longer becomes dependent upon a limited number of centralized organizations acting for profit, but instead, anyone can now provide the service via these open protocols. This means we can harness the resources of the many in a distributed fashion instead of being dependent upon a few. Likewise, the token economy can harness the motives of individuals not just for financial rewards, but for a multiplicity of values. To illustrate how this works, let's think about the service of cloud data storage. Currently, this is provided by a limited number of enterprises like Amazon and Microsoft. These centralized organizations have huge data centers, but still, those data centers are only a very small fraction of the storage capacity in the world. Most of the storage is in the personal computing devices of end users, and most of that is not being used. Filecoin is one organization that works to create a distributed token economy for this storage. Filecoin is a decentralized storage network that turns cloud storage into an algorithmic market. The market runs on a blockchain with a native protocol token, also called Filecoin, which miners earn by providing storage to clients. Conversely, clients spend Filecoins hiring miners to store or distribute data. The sum of all these computers that are coordinated through an automatic market system on the blockchain can provide a much larger, more resilient system than the centralized model while reducing redundancy and inefficiencies in the overall system. It also pushes the provision of the service out to the location where it is demanded, as people are connecting peer-to-peer locally instead of going to the centralized server that may be on the other side of the planet. Tokens such as Filecoins can be exchanged for other currencies, or members can hold on to their tokens whose value may appreciate as the networks grow over time. This illustrates a very interesting aspect to tokens. Anyone who uses the system is also an investor in the system. Thus, tokens merge investment capital and liquid exchange capital in new ways. In the traditional capitalist model, we have a divide between owners of capital and workers, a divide between a more fixed investment capital and liquid exchange currencies. The shares in a company are not the same thing as what people get paid with for working in that enterprise and use for everyday exchanges in the market. This creates the notorious divide within the industrial economy described by Karl Marx, between the capitalists that make money off their investments and the workers that have to stay selling their labor for money without ownership. Tokens represent both the inherent value of the community, which is its capital investment, and they are also units of exchange within that ecosystem. The founders of the project issue a number of tokens at inception and sell those. For someone to use the system, they have to buy the tokens. In so doing, they become part investors in the project, but they also use those same tokens to make exchanges within the market. Thus, the people creating the value in the ecosystem are also getting paid in tokens, meaning the workers that are creating the value through their work also have ownership within the organization. In the traditional utility-based exchange of cash, people have no ownership in the organization. They just try to make money, and this can create divides between the owners and the users. The token system works to better align the incentives of the individuals with the overall system because the value of the tokens they earn is also dependent upon the value of the whole. When you are working for a token network, you are both working for yourself and for the whole organization as the two become more aligned, unlike the traditional divide between capitalist and worker. The token system enables networks to overcome the chicken and egg problem. If you are the first user of a network like eBay, then the value would be very low. Thus, it is difficult to get the network started because it has to reach a critical mass before it will be of value to the users. This means that it may require a large investment to create a network. The Silicon Valley model worked by having large initial venture capital backing that enables them to overcome this. But it means that most networks don't get off the ground, and that once a network reaches scale and has value, it becomes dominant and very difficult to compete with, resulting in a lock-in effect and making it easy for large incumbent organizations to become extractive over time. It also means that those who founded the organization win big time. If the network takes off, it creates a winner-takes-all dynamic with most people losing because of the threshold. The token system extends the benefits of being an early adopter of a new network to all the users and thus helps to solve this issue. It does this by issuing tokens for anyone to purchase at the beginning of the project. As the project grows, the tokens come to have greater value for all of the holders. This also works to make the users of the network promoters of that organization because as it grows, the tokens that they hold become more valuable. It incentivizes people to join networks early so as to gain the benefits of the increase in their token value as it grows, which reduces the problem of thresholds. With this, technology companies no longer have to go to traditional capital markets through an initial public offering of shares in the company in exchange for money. But instead, they simply sell tokens directly on the internet to raise initial capital for the project in what is called an initial coin offering, or ICO. This means that founders can monetize their networks directly by simply holding their tokens and making the network useful. To date, we have had an internet patched onto the side of an economy operated through the many centralized organizations of the industrial age, creating a strong contradiction between the underlying technology and the institutional arrangements. The distributed web will work to transform this by merging information networks and economic organization as the flow of information and economic value becomes one. This will greatly reduce our dependency on centralized organizations expanding markets as systems of organization. The global market economy will become available to the many through small distributed peer-to-peer interactions running through web protocols as the decentralized internet takes us a step further into the networked economy.
So we have seen that how this blockchain technology is going to disrupt our market and how it is different from the traditional system. But the thing is that this does not come without concern. There is concerns also, like this can accentuate the digital divide. Means those who have a digital efficiency, they will be very benefiting. They will be getting benefit from it, and those who are not digitally literate or not capable, they will not able to get the benefit out of it. And second thing is that this is out of control of regulatory authorities, which can reduce the state's sovereign authorities uh, like central banks will not be holding this regulatory powers on these type of blockchain technology. And third thing is that this is a prone to illicit error funding, like terror funding, money laundering, and all these things. Fourth is the taxation-based problems, like that centralized authorities don't have that much of data, or they cannot get the taxation out of it. And fifth thing is that speculation activities, frauds, like one is this Bitcoin currency. We have seen that a lot of speculation activities are going on. Sixth is cyber security. Cyber security is a problem like if your digital wallet is hacked, then you might lose a lot of things. So these are the basic problems, and the purpose of the video was to make you aware about the disruptive technology that is a blockchain, so that if whole world is knowing about it, so we all must also know about it, because the information is the new currency, the big data is the new currency. So we have to have the track of information, whatever is going in the international level. But so anyone wanted to invest in token cryptocurrency must do with the proper risk analysis. We don't encourage someone to invest in any system based on blockchain technology, despite its promising future. So, friends, here we have seen that how blockchain technology is changing international and traditional setting. So I want you to write down answer for one question, that is a blockchain technology considered as a disruptive technology and it has a potential to alter traditional industrial setting. Analyze. So friends, so with this this comes to end, and please like and subscribe our YouTube channel, that is Educare IAS. So please, thank you very much.